$34 billion. That was the market capitalization of a corporation promising to revolutionize global logistics. For a brief, surreal moment in financial history, this zero-emissions automotive startup was worth more than the Ford Motor Company. They had secured billions in retail investments. They had forged massive strategic alliances with established manufacturing titans. They had convinced the world that the future of transportation had arrived. But their flagship product, a revolutionary, world-changing hydrogen-electric semi-truck, lacked a fundamental feature. It did not have an engine. How does a corporation convince Wall Street, legacy automakers, and millions of retail investors that a hollow metal shell rolling down a shallow incline is a multi-billion-dollar technological breakthrough? How does an empire built entirely on visual manipulation and carefully staged illusions bypass the financial immune system of the United States? Today, we open the books on the ultimate engineering mirage. Today, we perform the autopsy on Nikola Motors. To understand the pathology of this collapse, we must first examine the highly unusual financial environment that allowed the infection to spread. We must establish the sheer scale of the patient before the reality set in. The global financial markets were awash in excess liquidity, and the electric vehicle sector was experiencing a state of unprecedented, blinding euphoria. Investors were no longer looking for steady, predictable returns. They were desperately hunting for the next generational wealth engine. The market was highly susceptible to charismatic narratives, and it found its ultimate storyteller in a man named Trevor Milton. Milton founded Nikola Corporation in 2014. The very name of the company was a subtle, deliberate psychological anchor. By taking the first name of the famous inventor Nikola Tesla, Milton was immediately and subconsciously aligning his brand with the most successful electric vehicle company in the world. His pitch was intoxicating. He claimed Nikola had solved the ultimate logistical bottleneck in commercial transport, creating a zero-emission, long-haul semi-truck powered by a proprietary, highly advanced hydrogen fuel cell network. During a massive, highly publicized unveiling event in Salt Lake City, the company showcased the Nikola One to a roaring crowd. It was a sleek, futuristic machine. Standing on stage, Trevor Milton looked directly at the cameras and explicitly stated that the truck was fully functioning and ready to revolutionize the supply chain. He gestured to the glowing dashboard screens, the aerodynamic design, and the complex mechanics. The automotive world watched in awe. The momentum became unstoppable. Nikola eventually went public, but they did not use a traditional initial public offering. They utilized a financial vehicle known as a SPAC, a special acquisition company. A SPAC is essentially a blank check shell company. It holds cash, lists on the stock market, and looks for a private startup to merge with. Because this process is technically a merger and not a traditional IPO, the executives are legally permitted by regulatory loopholes to make highly optimistic, hypothetical financial projections. These are projections that would trigger immediate regulatory red flags in a standard stock offering. This mechanism allowed Nikola to project billions of dollars in future revenue without having sold a single functional vehicle. Almost instantly upon listing on the NASDAQ, retail investors flooded in. The stock price went parabolic. The euphoria reached its absolute peak when General Motors, a century-old pillar of American industry, announced a $2 billion strategic partnership to manufacture Nikola's consumer pickup truck, known as the Badger. General Motors lending its legendary manufacturing credibility to Nikola seemed to validate everything. The patient was not just healthy, it was hyperventilating with capital. But beneath the pristine corporate press releases, the core of the company was a complete vacuum. The necrosis within Nikola was not a highly sophisticated accounting loophole, as we saw with Enron. It was an engineering illusion. It was a systemic campaign of fabricated reality, driven by an executive team that understood that in the modern economy, perception generates capital much faster than actual production. Let us examine the primary vector of the disease, the prototype. When Trevor Milton stood on stage and declared the Nikola I a fully functional vehicle, it was, in reality, a stage prop. It did not possess a hydrogen fuel cell. It did not have a motor. The glowing dashboard displays were not powered by an internal battery system. A physical cable was secretly routed from backstage, run up through the floor of the truck, and plugged directly into a standard wall socket. The gears and hardware visible underneath the truck were assembled from standard commercial parts, specifically designed to look complex. To complete the illusion, H2 was stenciled over components that were actually designed for natural gas. It was a theatrical set piece. But a stationary prop cannot sustain a $34 billion valuation. The market demands momentum. Investors need to see the future in motion. So the executives simply manufactured it. The company released a highly polished promotional video titled Nikola I in Motion. The footage showed the massive semi-truck cruising smoothly down a sunlit desert two-lane highway. It was presented to the world as undeniable proof of their technological supremacy. The underlying mechanics of this video represent one of the most audacious deceptions in modern corporate history. Imagine a real estate developer selling you a state-of-the-art self-sustaining smart home. They show you a pristine drone video of the house operating perfectly. What they do not show you is that the house has no plumbing, no wiring, and no foundation. They simply filmed it from a flattering angle while secretly pulling it across a field with a tractor. Nikola engineers secretly towed the non-functional truck to the top of a low-grade 2-mile incline on a remote stretch of highway in Utah. They detached the towing vehicle, released the brakes on the Nikola I, and let gravity do the rest. The camera angles and the framing of the video were carefully manipulated to obscure the slope, making the road appear perfectly flat. The breakthrough technology driving a $34 billion corporation was not a hydrogen fuel cell. It was Sir Isaac Newton's law of universal gravitation. This culture of visual deception permeated every level of the company. When Nikola claimed they were producing their own hydrogen at a fraction of the market cost, they were secretly purchasing it from standard third-party suppliers. When they showcased proprietary solar panels on the roof of their headquarters, an employee had simply placed tape over the actual manufacturer's logos. They even appointed Milton's brother, a man whose prior professional experience consisted of pouring concrete driveways in Hawaii, as the director of hydrogen production and infrastructure. They had constructed an empire of renderings, but renderings do not generate revenue, and eventually the market demands an audit. Illusions of this magnitude require total airtight containment, no leaks, no rogue employees, no intense external scrutiny. But the perimeter was decisively breached by an activist short-selling firm named Hindenburg Research. Let us define this mechanism. A short seller is an institutional investor who borrows shares of a stock and immediately sells them, betting that the price will drop. If the price falls, they buy the shares back at the cheaper price, return them to the lender, and keep the massive difference. Because of this structure, Hindenburg had a calculated massive financial incentive to expose the truth. They published a devastating, extensively documented forensic report outlining how an ocean of lies was parlayed into a partnership with the largest auto manufacturer in America. The report was surgical. It did not rely on rumors. It relied on text messages, leaked internal emails, and photographic evidence. It meticulously detailed the rolling down the hill deception. It exposed the taped-over third-party inverters. It revealed the sheer lack of engineering capability within the company's highest ranks. The timeline of the collapse was rapid and ruthless. The moment the Hindenburg report went live, the market reacted with immediate shock. However, a massive faction of retail investors attempted to hold the line, waiting desperately for the company to defend itself. Trevor Milton took to social media, promising a comprehensive, point-by-point rebuttal that would destroy the short sellers. When the corporate defense finally arrived shortly after, it proved fatal. Instead of a robust technical rebuttal, the company issued a carefully worded legal press release that failed to deny the core allegations. Crucially, they addressed the video of the truck in motion. They admitted that the truck was rolling downhill, but defended the deception by stating they never explicitly claimed the truck was driving under its own propulsion. In the high-stakes world of financial markets, the semantic defense of a visual lie is an absolute admission of guilt. The illusion completely fractured. The United States Securities and Exchange Commission and the Department of Justice officially opened investigations into the company for securities fraud. The panic instantly shifted from retail trading forums to institutional boardrooms. The pressure became insurmountable. Late on a Sunday evening, as the investigations intensified, Trevor Milton abruptly resigned from his position and vanished from the public eye, deleting his social media presence. For a company whose entire valuation was built almost exclusively on the charisma and promises of its founder, this was the terminal phase. At the opening bell the following morning, the stock entered a violent freefall. The final lifeline to institutional legitimacy was severed a few weeks later when General Motors, recognizing the immense legal and reputational toxicity of the brand, drastically scaled back their partnership. They canceled their massive equity stake and abandoned all plans to manufacture the Badger pickup truck. The $34 billion valuation evaporated into the atmosphere, leaving thousands of retail investors holding virtually worthless paper. The forensic analysis of Nikola Motors yields a diagnosis of terminal hype, facilitated by an alarming systemic suspension of basic due diligence. Trevor Milton was eventually indicted, tried, and convicted by a federal jury on multiple counts of securities fraud and wire fraud, leading to a federal prison sentence. But the pathology of this event extends far beyond the actions of one individual. How did elite financial institutions, Wall Street analysts, multinational automakers, and millions of retail investors purchase a multi-billion-dollar stake in an automotive company without verifying if the core product actually possessed a motor? The answer lies in the most dangerous psychological force in finance: fear of missing out. In the frantic, desperate search for the next generational wealth engine, the market collectively decided to stop asking basic, critical questions. They outsourced their skepticism. General Motors assumed the investment banks had thoroughly checked the technology. The banks assumed the retail investors loved the brand. The retail investors assumed General Motors would never partner with a fraud. It was a circular dependency of ignorance. When the desire for infinite profit overrides the demand for mathematical proof, gravity eventually reclaims control. You can fake a dashboard display. You can manipulate camera angles. You can utilize a SPAC to bypass regulatory friction and project billions in phantom revenue. But eventually, the vehicle must drive up the hill, and physics does not accept fraudulent projections. The markets never forget, but they do forgive the next fraud. Subscribe to Fiscal Autopsy to see who falls next.